Kia ora, my name's Kirsty Muckle, the Engagement Manager for Branches here at Engineering New Zealand. We really appreciate your time today dialing into the session. Before I pass over to Steve White, who is on our Nelson Marlborough branch, just wanted to say a few things. So we are recording today's session and we will send you a link to that recording in due course. Any questions that you wish to ask Belinda, please use the barcode, the QR code that you can see on screen. If you don't have any questions though, you can actually vote for questions that we have received and those will be answered towards the end of the presentation. We have received a number of questions already and would recommend that you vote for those that you would like to be asked during the presentation today. If not, if we have any answered questions, Belinda will provide those details and we'll send you that information along with the recording. Thanks to everybody that's organised today's event. We've had over 280 people register, so thank you again. And now over to Steve. Thanks, Steve.
Thanks, Kirsty. Kia ora, tēnā koutou katoa. Nā mai haere mai ki tēnei hui, ko Stephen White toko ingoa. Nā reira, tēnā koutou, tēnā koutou, tēnā koutou katoa. Hello, everyone. My name's Stephen White, and as Kirsty said, I'm in the Engineering New Zealand branch chair for Nelson Marlborough, and I'm also the lead water engineer at CGW Engineers. I'm pleased to welcome you to today's webinar, which is in lieu of our planned face-to-face event. This event's a collaboration with Te Kaui Whaihanga, Zero Carbon Nelson Tasman, and New Zealand Coastal Society. I'll briefly talk through some housekeeping, and then I'll hand over to Nathan Edmondson, the local architecture chair, and we'll introduce our speaker. And then I'll be back on again at the end to ask some of the questions from the Q&A. Firstly, at our Engineering New Zealand events, we always cover health and safety. So in the event of an emergency, please follow the procedures for wherever you're watching this from. And don't worry, you can watch the recording later once that emergency is over. Please remember to keep hydrated, enjoy some kai if you have some time, and blink regularly to avoid those dry eyes. So we've allowed about 40 minutes for the presentation, and then another 40 minutes to get through all your questions. As Kirsty mentioned, these questions all need to be posted on Pigeonhole. And very importantly, please vote for the ones you like to be asked. So we'll be working through them from the most popular down, so that very important that you all rank them so we can get through those most popular questions. And also, if you have a question and you see there's one already in there that's similar, please vote for the one that's similar rather than ask the same question again, because then it will be clearer with the voting. I'll now hand you over to Nathan from Kahui Whaihanga, the New Zealand Institute of Architects, to introduce our speaker.
Thank you, Steve, and it's good pleasure to be here today as well, and thank you for this collaboration. It's been good working on these two sessions over the last couple of years. So just as a brief introduction, so more than 90% of heat created by human activities has been absorbed by the ocean, which has helped to moderate the climate until recently. But with this came huge sacrifice to the marine environment, coral bleaching and ocean acidification, to name a few. The ocean cannot absorb excess heat any longer. The latest IPCC report tells us that we need to start long-term planning now, so that we can better adapt to climate change. Sea level rise has had a significant impact on coastal regions like ours. But architects and engineers are still being asked to help develop at-risk areas where flooding and coastal inundation risks would intensify in the near future. How long should we continue to build in these areas? Is it safe for the occupants? Is it good for the future generations? Is it ethical? What are the impacts to marine and coastal environments and everything that lives there if we don't plan for managed retreat? These are the questions we are trying to answer, and we need to do it collectively. Today we have Belinda Story, who will present her latest research. Belinda is co-founder of Canuti Limited, a startup developing quantitative tools to price physical climate risk. Her work focuses on the impact of escalating hazards on infrastructure, property prices, and insurance availability. In 2017, Belinda coined the term insurance retreat, and in December 2020, she published Insurance Retreat, sea level rise, and the withdrawal of residential insurance in Aotearoa, New Zealand. Today she will present a new model for valuing property under climate change called Climate Leases. Belinda is also Managing Director of Whakahura Extreme Events and the Emergence of Climate Change, a 5-year, $10 million research program funded by MBIE, and is a member of XRB's External Advisory Board on the new climate-related financials disclosure bill. At the end, she'll be joined by Greg Bodecker of Canute as well to help answer questions. I'll leave it to you, Belinda.
This new concept of climate leases. So you all presumably will be familiar with the event that happened in Westport in July of this year. This is a photo taken by the New Zealand Defence Force, and in the background you can see the Buller River. The model that I've developed, Climate Leases, is a potential response to locations like these that are facing escalating hazards. This is a location that is near the sea. The primary risk is from river flooding, but as I'm sure you know, that when sea level rises, any sort of on-land runoff is more difficult to drain when that sea is higher in the long term, or even on a temporary basis with a storm surge. So I imagine, given that the audience today is primarily engineers and architects, I imagine that the engineers among you may have already started to think about an RFP about how you might respond for Westport. And that RFP might focus, for example, on how you can strengthen the defences and attempt to hold back the Buller River. What I'd like to talk about is, how are you undertaking that analysis? What climate modelling are you incorporating in that? And what confidence do you have that the climate modelling you have is going to adequately represent the changes and extremes that these locations will hold? When we think about locations that are facing hazards, the IPCC has a framework, which I imagine you're familiar with. So on the left-hand side, climate change is changing the hazards, so weather and climate events. And so the way to respond to that is obviously through mitigation, so reducing the global emissions. But from an adaptation perspective, we need to be thinking about how we respond to either address vulnerability or exposure, or both. These are a couple of photos I've taken personally. And what you'll see here is a defence on the Cook's Beach. So this is a mechanism trying to reduce the exposure by keeping the water out, for example. Accommodation is a mechanism where you allow the water to come in, but you make your homes less damaged by the event. So this is a location in Connecticut, and when I heard that they had, I was visiting friends there, when I heard that there was a part of the town that had had severe flooding, that they had elevated houses, I immediately wanted to go and take some photographs. And what you can see is this house has been significantly elevated. But there is a key question about what that does for our community, in sense of when houses are elevated like this, what does it do in terms of the type of demographics that are able to remain in those properties? So, for example, people who are less abled or the elderly, lifting houses will potentially reduce the access for them. Another couple of responses that can be undertaken to reduce vulnerability is public insurance. And when I first presented the insurance retreat work last year, I did a series of briefings for central government. And what I found is overwhelmingly there was a perception that the answer to insurance retreat was public insurance coming in. I got so many people suggesting this that we actually called the EQC and said, by the way, guys, you need to know, everyone's thinking you're going to be picking this tab up. What I would say, though, is that if you have private insurers withdrawing, they're withdrawing because the hazard has become to a point that they're not able to support it on a break-even basis with actuarial formulas. So if a public insurer comes in, they will be undertaking significant subsidization. And what we have found observing situations overseas, so the National Flood Insurance Program is the program in the States that's been around since the 1960s, and I'll talk briefly about that towards the end of our talk. And Flood Re is a more recent program that's come in, which is a industry-based program but with an implied government backstop. Both of these programs have an expectation that the risk will be reduced, but in reality, once you provide that subsidy, you actually find that people remain in the most hazardous locations because of that subsidy. And then the way to completely reduce risk is to eliminate the exposure. And so managed retreat, this is a picture taken of the red zone in Christchurch, and by moving people out of that location, they were no longer exposed to the hazard, in this case primarily liquefaction. So there are a number of different responses that can be undertaken, and the research that I'm doing is looking at a staged approach for managed retreat, given that there are these limitations of the other responses. So what I find is that when I'm looking particularly at coastal property, but also locations that are with escalating hazards, perhaps in floodplains, is that climate change is effectively converting permanent ownership rights into temporary use rights. But at the moment, those properties are continuing to be bought and sold as if people are able to remain there indefinitely. So the model that I've developed is climate leases, which is based on that premise, which has been under development since 2016. When I first started working on this, I thought that the key threshold was when the land disappeared, when the water came to your front door. But when I started undertaking the financial modelling of this, I realised that there were a number of thresholds well before that, sometimes decades before then, that mean that the costs of remaining in place are so great that they overwhelm any amenity value that the property has on an ongoing basis. And so that's how I came to look at these series of retreats. Insurance retreat is often the first one. Credit retreat relates to when you are unable to get a mortgage on a property because the banks do not have confidence that the house itself can be used as collateral for the loan. Infrastructure retreat occurs when the local government finds that they're unable to continue to repair or renew the pipes and wires and road to your property. Your property itself might be fine, but if your road continuously gets washed out and the council reaches a point where they're unable to continue to repair that road, then that will have an impact on the value of your property. Intolerable risk to life is something I don't quantify, but I recognize that there are some locations that as a society we will say that we don't want to have in the most hazardous locations. So for example, you don't want to have a retirement home or a creche in a tsunami zone simply because the speed of evacuation that is required isn't going to match the capability of those people who are in those locations. So I'm going to talk a little bit about the formula of climate leases, and then I'll talk in more detail about the insurance retreat work. When I first started working on climate leases, I looked for the work on insurance retreat and found that sometimes when you undertake a piece of research, all of the pieces aren't there. So you need to undertake further research to fill those out. So that's the piece of research I did last year, which I published last year on insurance retreat, which I'll talk about at the end of this talk. So the concept of the lease is that over time, you have a property reaching the point where it is the costs of remaining in that location outweigh any amenity value that you receive. So that's what you would see as the end of the lease period. But what this methodology allows you to do is see how the value of that property changes over time as you approach the period of safe occupation. So here's an example where you've got a property that might be have reached the point where the break-even point in 2070. And so at that point, the value of the property reaches zero. But what this model helps you do is calculate how the value of it changes. So what would the value of it be in 2060? What would the value of it be in 2050? And this is based on a concept called lease relativity, which is used in the real estate market, not for climate change, but for residential properties. And what it says is if you had two properties, one property that is not exposed to the climate risk and one property that is, but is identical in every other way, what is the value of the lease property relative to the freehold property? So that's what this axis here is demonstrating. So what the lease concept allows you to do is say, how much is the property overvalued today relative to the fact that it's got there will need to be an extinguish of permanent rights in 2070. Embedded in this curve is all of the escalation in costs that occur when those hazards become more severe and more frequent. So there's a number of different components that sit behind this curve, but this is just a conceptual introduction. What this means is that you're able to see how much the property is overvalued today, but it also helps you decide how much you might want to spend on potential defences. So what you can see here is that if, in this particular scenario, a property that's finishing in 2070 has 70% of the value of a freehold property. So it's effectively, if they are currently priced the same, even though they have these very different risks, you would argue that this property is overvalued by about 30% today. If we take a different example, if we take down to a property that has only, say, 25 years left on it, the interesting thing is that the curve becomes steeper and the reduction is not as much as you might think. So when I talk about insurance retreat and climate leases, people presume that property prices will collapse. They don't collapse because people recognize that there is the opportunity to enjoy that amenity value over the next 25 years. And because we value experience today more than we value an experience in 50 years' time because of the time value of money, it means that it still retains a significant amount of value today. What that does say, though, is that if you've got a property that's likely to reach the end of its life within 25 years, and someone promises to build a defence, so a seawall or a riverbank, a key analysis that needs to be undertaken is how much more time that seawall or stop bank is buying. Because if it's only buying a few years, apologies, there we go. Sorry, there's a slight delay here. If it's only buying you the difference between 70% and 55%, then I would argue that the maximum amount that you should spend on getting that extra time is the difference between the two. So if you are putting in a seawall and it's going to buy you another 25 years, the maximum amount you should spend on that seawall per house should be the difference between the two. At the moment, when seawalls and stop banks are built, there's a presumption that it will provide amenity indefinitely. And so it implies a level of protection that is permanent. But as these hazards escalate, that defense is only temporary. It's not a permanent protection, it's a temporary defense. So the thing that's interesting is even properties that have only, say, 15 years left still retain a significant amount of value, again, because that there's still 15 years worth of amenity to be enjoyed. So this is a summary of a range of the different scenarios. These are just scenarios. What Canute can undertake is that analysis on a house-by-house basis. So if we look at the example of Westport, this is just a very rough estimate of the property values of this particular street. What you'll see is that there's some houses that are of higher value. These are houses that have been rebuilt in the last few years. Most of these houses were built in a century or 80 years ago, but some of the houses are starting to get rebuilt, and not surprisingly, they're the more valuable houses. What I would argue is that we could spend tens of millions of dollars fortifying the stock bank, or we could recognize that there are parts of Westport that are unlikely to be able to be safely defended, and consider putting a lease period on that. People can buy and sell during that time. But if you look at what the difference in perhaps buying that conversion from freehold to leasehold, it is likely to be equivalent to or less than the cost of trying to hold back the river. So as I said, part of the key, when I started working on this, I was wanting to identify each of the different inputs into the model, and I found that insurance retreat was something that there wasn't strong evidence looking into the future about what that was, so that was the research I undertook, and I'll talk through briefly that now. So what we find with climate change is that climate change is shifting these distributions. In New Zealand, a small amount of sea level rise is sufficient to shift this distribution to the right. And so what I'm going to talk through is about some of the modelling that comes into estimate what these events are looking like. When it comes to climate change, scientists have the most confidence about predicting the changes in temperature for different emission scenarios. They have confidence of sea level rise if we exclude the Antarctic ice sheets. In terms of precipitation, there's less confidence. It's harder to model that, and at the moment it is almost impossible to model how storm surges are changing into the future. So what's happening is climate change is shifting these curves to the right, and what that means is that you'll have a new event in the new distribution. So this is an example where the distribution is shifted by 1 standard deviation. I accept that this is a normal standard curve. Many natural phenomena follow this, but there are some that don't, but this is the one that we use for the purposes of explaining the concept. When this distribution shifts, the new mean will feel quite familiar to as terms of the old distribution, because it happened about once every 6 years if you have a 1 standard deviation shift. So the new mean will feel fairly familiar, but it will result in a significant shift in the extremes. The climate models, the global climate models, and even the regional climate models are very good at telling you how much the means are changing, but it's much more difficult to look at how the extremes are changing. And what you'll see here is I've put in a darkened area here of insurable events. So insurers don't insure everyday events, they insure rare events. And the concept of climate retreat is that as these distributions shifts, insurers will shift with them because there will be a significant increase. And I'll come to that in a minute, but just before we do that, I'm going to talk a little bit about one of the areas that the climate models struggle with specifically. So this is an example of what the New Zealand topography looks like in the global climate models. So the global climate models need to split the world up into segments that they then run each of the equations within. And in order to be able to include all of the complexity of the climate models, this is the level of resolution that almost all of the global models on climate change incorporate. What you'll see is they say that the highest height in New Zealand is about 700 metres, and it's a plateau over the Southern Alps. And you also see that it's suggesting that the topography on the west coast is pretty much the same as topography on the Canterbury Plains. Some of the better global climate models will be able to do it at a 1 degree by 1 degree. Just to give you context, over New Zealand, that works out to be about 100 kilometres by 100 kilometres. So it's just over New Zealand, you can see that as kilometres. So this is what the best of the global climate models will provide. And there are some modelling in terms of extreme events. So Weather at Home, for example, which is a key program inside the Embry program that I manage with Dave Frame. They are able to do that at 50 kilometre, and they're about to move to 25 kilometre. But if you're wanting to make decisions about at an asset level, asset specific level, you're going to be wanting to have information that is much more like a 5 kilometre by 5 kilometre, or even a 1 kilometre by 1 kilometre. And so what happens is, this is what you need, but this is what's available in the climate models. So the climate models are very good at telling you how the global model will change, but because of this complexity, they need to have relatively coarse resolution, and they can only run the model a few times. So for example, if they were to run this, for example, at a regional climate perspective, they can only run the model 2 or 3 times a year. They can't run the model 1,000 times to find the 1 in 1,000 year event. So that is something that Canute is working to develop, is the next generation of climate models. They are designed for financial decisions, not to answer scientific questions. So what we are doing in Canute, and Dr. Greg Bodecker is available for questions at the end of this, for anyone who wants to get technical. I'll leave that to you guys. I just do the finance. That is what we're finding, is that climate change is going to shift these distributions to the right, which is resulting in a much greater probability over the existing events. But climate change is also going to shift the distributions, change the shape of the distributions itself. And what we expect is that as these distributions shift to the right and change in shape, insurers will continue to move with them. They will continue to insure the 1 in 50 year event, perhaps. They'll definitely insure the 1 in 100 year event, but they're not going to be insuring events that are now have an annual exceedance probability of 5% or 10%. So one of the pieces of work in terms of the insurance work was to understand what the insurance retreat thresholds are. No insurer will tell you what that answer is, and I've got lots of confirmation of, we recently presented to the Actuarial Society and they all laughed at, yes, they'll never provide that number to us. But we can see some evidence of what has happened in terms of locations that have lost insurance. From an actuarial break-even perspective, it is very unlikely that insurers are going to be able to continue to charge people insurance at 4% AEP. So that's about a 1 in 25 year event. When we did the work on insurance retreat, we took an even more conservative number, which was the 5% AEP, which is about a 1 in 20 year event. Interestingly though, in the UK, what we know is that private insurers threaten to withdraw once insurance annual exceedance probability reached the 1.32%, so the 1 in 75 year. So the numbers that you'll be seeing in terms of the timings for insurance retreat were very conservative. It's quite likely that insurers could withdraw before the timeframes that I'm talking about. In terms of sea level rise, a key thing here is that the sea level projections that are relevant for insurance retreat are very much locked in. There's very little difference between the different represented in concentration pathways. So these are the emission scenarios. There's very little difference over the next 20 years. So we tested the model in terms of different RCPs, but it added on maybe 1 or 2 years. It didn't make any material difference to the timing. There is more variation in terms of the sea level rise when you get out to 2100, but in terms of the amount of sea level that we're going to receive in the next 20 years, they were baked in by emissions that have happened over the previous decades. So there is very little uncertainty in terms of the lower bounds of the sea level rise. We potentially could see more than this, but the analysis that we undertake is at this this 2040 level. So what we did is we undertook generalized extreme value analysis of the ports within that had sufficiently long records to be able to undertake that analysis. And what we found is that there was just very little difference between the probability events for a 1% AEP and a much more frequent event. That is partly because we have tended to hug our coasts very tightly since European colonization. And the storm surges that we have here are relatively small. So they haven't had just a small amount of sea level rise lifts the storm surges into locations that previously haven't been exposed. So what we found is that there was a different steepness in terms of each of the different locations, and this was primarily driven by tidal range. That is somewhat good news for Nelson, which has a very large tidal range, but it means that the insurance retreat occurs somewhat later. Doesn't stop the insurance retreat, but it means that it happens somewhat later. So what you see is this is the generalized extreme value curve that intersects at the 1% AEP, and it says how much sea level rise would it take to shift this to a, for example, a 5% annual exceedance probability. We did this modelling independent from the work that was undertaken by the Parliamentary Commissioner for the Environment, but we were able to validate our results against that, so we were consistent with the results that they undertook. I'm going to give a quick demonstration here about why tidal range matters. And so this will be straightforward to some of those who specialise in coastal, but for those who are thinking about coastal property in locations, I think it's helpful to understand how the tidal range makes such a difference to the probability of events. So here we've got an example where we've got a tidal range of approximately 4 meters, which is closer to what Nelson has, for example, than Wellington. So what happens there is that when you've got a wide tidal range and you get a storm surge come in, then you're more likely that the storm surge can be absorbed by the existing tidal range. So here what we've done is I've split the tidal range into quarters. And what you'll see is that if this storm surge comes in at low tide, it doesn't matter. It falls well within the existing tidal range. It only becomes an issue if it comes when you're either at high tide or perhaps 3/4 tide. At 3/4 tide here, you'll see that that exactly the same size storm surge is now able to overtop. But 75% of the time, it won't. It'll be absorbed within the existing tidal range. However, if you've got a much smaller tidal range and you've got the same size storm surge come in, again, if it's below at low tide or at below mid tide, it'll be absorbed within the range. But if it comes anywhere at mid tide or above, it will overtop. So what that means is in a wide tidal range, that size storm surge will be absorbed 75% of the time, whereas here it'll only be absorbed 50% of the time. So that means that the same size storm surge around the New Zealand coastline can have very different probabilities of overtopping dependent on the size of the tidal range at that particular location. So what we then did is we matched those to the increase that we're expecting to see in sea level. So we matched these curves to that, and we found that there was a significant that Auckland, for example, reached that 5% AEP much, later than Wellington. We then mapped that to the sea level that we are expecting to see over the next 20 years. And what you'll see is that Wellington and Christchurch can expect to start to experience partial retreat. So partial retreat is where an insurer starts to transfer some of that risk back to the homeowner or the property owner. And that can be in the sense of very large excesses. So for example, in Flockton Basin, which had a sudden loss of elevation because of an earthquake overnight, they $10,000 excesses were placed on properties for flooding because a bowl was effectively formed. So that's an example where you technically can still get insurance, but for the hazard that you have the highest risk from, in this case in Flockton Basin flooding, $10,000 excesses were put on, so that What that means is that if you have a flood that will cause catastrophic damage, you are covered, but you won't be covered for the types of damage that may occur more frequently. So what we are based on that threshold of 2% for partial retreat and 5% for full retreat, AEP, we're expecting Wellington to reach that full retreat threshold sooner than Christchurch, just because of the shape of those curves. Auckland is later. Auckland and Dunedin are later, but not by much, and they do have a later full retreat. So because of, we haven't undertaken the analysis on Nelson, that is something that we are able to do. But what I would expect is that because of the tidal range, you would expect to see a fairly similar timing to Auckland. And that's because your tidal range is significant. It was one of the largest in the countries. Key issues around insurance itself. So some of the things that have come out in part because of the research that I've been leading. There's a lot of discussion about property insurance at the coast. It's one we have the highest confidence in because the sea level is the area that we have the most confidence in. However, for every house that we have in a 1% AEP at the coast, there's about 10 in floodplains. So there's far greater numbers in floodplains, but they're less, there's more complexity in being able to model the change in precipitation. So that is something that Canute is undertaking, is looking at the modeling of those extremes and building that next generation of climate models to do that. There is very likely to be strong demand for hard and soft defences. And that was part of the deal, for example, in the UK with Flood Re. So when private insurers began to or threatened to withdraw from private insurance for flooding, there was a series of negotiations between the insurance industry and the government in the UK, where effectively the government committed to invest more in hard and soft defences to lower that risk in the short term. Now, bear in mind, an insurer is only asking the assessment of their risk is only for the next 1, maybe 5 years. So yes, building a hard or soft defence does provide some reduction of risk, but the payback period for that piece of defence may be much greater than the commitment period that the insurers are putting in place. So if we take that example of Flockton Basin, the local government spent about $40 million on pumps. And once they had done that, the insurers reduced the excesses for that location. But the key thing to bear in mind is the insurer is only agreeing to reduce that excess for the next 12 months. They're not committing to anything longer than that, but the payback period on those pumps would be far greater than that period. Another issue that is currently experienced at the moment is this piece around public understanding of policy terms. There will be some homeowners who believe that they have insurance for their biggest risk, but when it comes to make a claim, they may find that there are policy coverage exclusions. So this is something that definitely happened along the coast in Australia, and what they found is that people who had whose greatest hazard was storm surges and had been long-standing customers of insurers, when storm surge damage occurred, some of them found that they weren't covered because there were exclusion clauses in their policy. Another one is this piece around public insurance. Public insurance subsidizes development in the most hazardous locations. And there's a classic example, which is Hurricane Betsy in 1965, which was the impetus for the creation of the National Flood Insurance Program in the US. That National Flood Insurance Program is not able to break even. It is not able to capture the premiums that would cover the actuarial formula of the risk, and it's heavily subsidized. It was intended to grandparent those and provide a level of support only to those houses that were currently in floodplains at the time Hurricane Betsy hit. But instead what it did is it provided this very significant public subsidy that then supported waves of development along the US coast starting in the 1970s. And so instead of reducing the risk, it led to a massive increase in the total amount of assets that were exposed at the coast. One of the locations that was most damaged by Hurricane Betsy was New Orleans, and in particular the 9th Ward. 40 years later, after Hurricane Betsy, Hurricane Katrina came into the 9th Ward and caused mass fatalities. If that subsidization of the insurance had not been in place, it is quite likely that the intensification of properties and people living in those locations would have been reduced. But what the subsidization did is it helped lock people into the most dangerous locations. Some of the things that are emerging issues from the insurance perspective, and these are conversations that we have had with the Reserve Bank as the regulator of insurers. There is a key question about capitalization of new entrants. So as a insurer withdraws from some locations, you'll have seen some interviews where people say, I wasn't able to get insurance from my existing insurer that I've been with for years, but my broker found me someone else. I've never heard of this company, but somebody else is willing to take. You kind of don't want to have insurance with a company that no one else has heard about, because you want to make sure that the company that you have that insurance policy with is adequately capitalized at the time that you you need to make a claim against that policy. At the moment, New Zealand has very high levels of insurance, in part because we have EQC underwriting our earthquake insurance. Just a point of comparison, I fully support public insurance for earthquake risk. Earthquake risk is something that we are learning more about, but the risk itself is not changing. The hazard is not becoming more frequent. So there is a different treatment that is needed in terms of earthquake insurance versus climate change. Bringing in subsidized insurance on a location where the probability of the hazard is increasing is not advisable. And so while I fully support EQC for subsidizing earthquake insurance, because of that changing in the probability, I don't support it for climate change. That said, because we've had significant levels of coverage under EQC, we do enjoy very high coverage in New Zealand. We have a bundled insurance, which is uncommon in other locations. But what we would expect to see is that there could start to become unbundling insurance. So whereas you might get insurance on fire for your property, if you're not near a forest, for house fire, you might not get it for flooding. At the moment, if you can get insurance for fire, you can probably get insurance for most of the hazards in your location. But we're expecting there to be unbundling, and with unbundling, we would expect that there would be some locations that either some households that don't have insurance or start to underinsure. Another key change is what disclosure of risk by insurers is likely to do to other parts of the industry. So you will have heard I'm on the external advisory panel for the XRB, which are defining the accounting standards for the climate-related financial disclosures new bill. And what we expect is that there will be, as insurers start needing to report on their risk, there will be implications for other parts of the industry that use insurance. So there are likely to be impacts for construction companies, for example, if insurers need to start being more explicit about what they are and aren't insuring. And insurance retreat we expect to happen later for infrastructure. So from a commercial perspective, insurers are more likely to price the risk and continue to escalate the price for as the hazard escalates. Simply because a commercial buyer is a more sophisticated buyer and will have their own in-house expertise on insurance. So we would expect insurance retreat to happen later in insurance, but it will happen in some locations. So we are expecting that there will be some stop banks, for example, where at the moment the local government is thinking about the size of the asset and the insurance on that asset. They're not thinking about the liability that they would face when that asset fails. So we know that the insurance industry has said, for example, that one of the direct avenues for them is to sue the council. So if you are an insurer of residential properties and your residential properties are flooded because of the failure of a stock bank, one of the most direct routes for the insurer is to sue the council for the failure of that bank. So that is something, for example, that is starting to happen internationally. There was a significant and successful claim by residential insurance companies against a major utility in California for the failure to effectively for precipitating a wildfire. But a similar sort of legal approach would be undertaken where infrastructure fails. So it's not just the insurance of the asset itself, it's also insurance of the liability you would face when that asset fails. And I wanted to give a quick touch on infrastructure retreat. This is a subject of a separate presentation if that's something you'd like me to do, but we are working on an infrastructure retreat. And I want to give you an example of a town in northwest Wales. And what you'll see is there's a seawall that has been built over a period of time. But the local council reached a point where they realised they were spending so much on the seawall, they weren't going to be able to continue it. So they did one last strengthening of the seawall. And then they gave notice to the township of about 400 houses, I think it was, to say that we're going to strengthen the seawall, but we're not going to strengthen it any further. And we anticipate that it will start to reach its end of life in 30 years. And so we're giving notice that you will need to be out of here within 26 years. So the council made a very bold decision and communicated that to the community and started having consultation with the community. And interestingly enough, the expectation would be that house prices would collapse. What happened was the property market froze. It initially froze, but then property prices adjusted to about what I would have seen in the climate leases model. Another key question we need to ask is that when we're thinking about fortifying, what are we losing when we fortify? When we fortify our waterways, we end up with these very hard structures that start to impact on ecological values, public access values, and even for the homeowners themselves. So this is the property values in this location fell by about 40% once this notification was made and people were confident that it was the council meant business, which is about what you would expect in the climate leases model for about 25 years. This process is ongoing. Watch this space. So these are some key questions that we are working on at the moment, and I'm keen to hear what you're interested in.
Thanks, Belinda, for that great presentation. We can see the positive engagement already with lots of questions coming through. For those that have been asking about receiving a recording, we will be sending a recording to everyone that is registered in due course. And for those listening, please remember to post any questions in Pigeonhole. And most importantly, at this point, start voting for the ones you'd like asked first, as we'll be working from the most popular ones downwards. So the first question is one that's proved very popular. It's from Katrina. The question is, what's the best way for engineers and architects to help our community with these issues?
The key, I'd say there's two pieces to that. I'll start with the biggest opportunity. So from an architect's perspective, there are going to be locations that we're going to need to move out of the way. We will have some time to do that in many of these locations. And during that time, homeowners may want to renovate, or they may want to extend. And in some cases, they may want to rebuild. But I think there's a real opportunity from an architectural perspective, is helping those homeowners with designs that can be moved. If we are in locations where we recognize that there is a time limit, if we're able to undertake construction today, whether that's renovations or even rebuilds, that will allow those properties to be moved to safer locations, then I think that's a real opportunity. And there's an opportunity for a whole range of innovation in that space that would not just be relevant to New Zealand, but would be relevant globally. From an engineering perspective, I would encourage you to test your thinking to move from this idea of permanent protection to a temporary defence. And make sure that when you are undertaking analysis of that defence, thinking about how the changes in extreme events are likely to shorten the payback period on that defence. There will be situations where there's opportunity for innovation and accommodation. So that's about making houses or commercial buildings more resilient, more able to absorb the water or similar. But always keep in mind whether this is buying time or locking people in.
Thanks. It's lots of ideas there for changing our thinking on things. The next most popular question is from Ben. In an area with sea level rise predicted over a number of years, would insurers tend to retreat when the risk is identified but hasn't eventuated, or retreat closer to the time of it being realised?
The incentives for the insurer to remain in market for as long as they're able to be profitable. So even if a risk is identified that a location is likely to reach a 5% annual exceedance probability in 10 years' time, the insurer has every incentive to remain in location for the next 2, 3, 4, 5 years. So they will remain in that location. And the key reason for that is that insurance policies are only for 12 months at a time. So they will be incentivized to remain in place for as long as the amount of money that they're able to receive from premiums is greater than the expected losses they would incur on that property. So they will, they have that incentive to remain in place. And part of the reason that I undertook the research is that there is no real incentive for an insurer to think further out. They only need to be thinking about the next 1, maybe 5 years. But obviously, if a property is likely to lose insurance in the next 10, 15, 20 years, that is something that is very relevant to the homeowner and to the local government and to policymakers. So that is, insurers are likely to remain in market. Now, the one caveat I would put with that is that insurers are human and they sometimes underestimate risk the same as the rest of us. So you may find situations where an insurer expected to remain in place, but because there was a significant event elsewhere and they experience an aggregated loss across a significant area, they may pull out sooner, but that's more as a response to their overall portfolio than it is because of that particular location.
Great. The next question is a local one. This is from Rachel. It's got Nelson City Council is planning a library development on a riverside site. It's modelled to be at risk of coastal inundation and river flooding. Could this community investment be at risk of insurance retreat?
I haven't undertaken the specific analysis of that location, but from what it's described, it suggests that it is likely to. And so the question would be, is if you're building a library, which is by design a place for people to gather, and you're creating a situation where you're wanting to encourage other development around that location that people will gather, are you setting up a structure that is going to have to be defended and will have risk to life if you need to evacuate.
Yeah, great points. The next popular question is, through Te Tiriti o Waitangi, many Maori communities have received coastal lands and those near rivers. How is your research helping address climate justice issues related to land ownership?
So I don't lead any of that research. I am a supporter of research in that space. So I'm part of a Deep South National Science Challenge program. I'm expecting to receive a copy of the report in the next day or two, where they are undertaking particularly the impact on the availability of insurance for marae that are low-lying. So I provide my expertise to Vision Mataranga leaders in that space.
Great. Next question is from
Just
Jenny. What role do you...
Sorry, if you're wanting to hear a bit more about that, there's an article in the latest New Zealand Geographic where they talk about my research and also the research of the Māori researchers leading work in this space.
Great. The next question is from Jenny. What role do you expect banks to play in insurance retreat and climate leases?
So banks are, insurers have been modelling risk for as long as insurers have been around. Banks have been modelling financial risk, but not natural hazard risk. So there is quite a capability build that is currently being undertaken in the banking space. What I can say is that once you lose insurance, you're very unlikely to be able to get a mortgage, because the property, the bank is therefore unable to rely on the collateral of the property. You're unable to use the property as collateral for the loan. So what that means is your cost of capital is likely to go up. There may be some banks that might consider providing you with a loan, but you're very likely to need to have a second property to be able to use as collateral for that loan. The other way that banks might respond is they may, for example, ask you to have much bigger deposits on the loan and have shorter terms. So if you have a property that is facing escalating hazards, but the nature of the hazard means that it might cause 20 or 30% damage to the property. For example, that's in flooding, whereas in wildfire, you can have 100% loss. Then you might find that in flooding locations, banks are willing to lend if you have a 50% deposit and you have a short time frame. In wildfire, because the damage to the property is so great, you're either burnt or you're not. It's quite binary. Then you may find that banks are less likely to lend to wildfire locations with any size deposit, simply because of the impact when you lose insurance.
Thanks. The next question is from Ben. Are social and other consequences of insurance retreat considered, particularly from a government side? For example, increased carbon emissions from resultant urban sprawl, removal of communities.
So again, that is something that I provide advice to, but there are researchers who specialize in this space, and that is definitely conversations that are currently being undertaken. So there are key questions that have been assessed about what the impact of insurance is on community values. A couple of the key researchers are Catherine Irons, Catherine Irons at Victoria, Lisa Ellis at Otago, and Ian White at Waikato.
Okay. The next question is from Katrina. What do we do, I presume this is engineers and architects do, when we are asked to help others spend money and carbon in areas that we may retreat from in the future?
So I guess there's a key point there is there may be situations where you can currently build and there is funds available to do that. But these structures will be in place for a significant period of time. And while your current clients may be asking you to undertake that, engineers and architects are very dependent on their people, the talent pipeline that comes into your organizations. So I guess I would ask is, how will your future graduates, who are going to be a key component of the future of your firm, going to look at the structures that have been built in these hazardous locations? So while there may not be a current reputational risk, I suspect that it will become a reputational risk and may impact your ability to recruit the next generation of engineers and architects.
Thanks. Some big things for the listeners to think about as well. The next one's from an anonymous person. Could you tell us the difference between residential, commercial, and public asset insurance in terms of how quickly insurance may retreat or the amount of premium increase they might face?
Mm-hmm. So I would expect, now this research hasn't been undertaken, but I would expect that the sequence of events would be that you would have retreat first from retail, secondly from public, and third from commercial. And the reason for that is that in the retail space, insurers are very reluctant to be seen to be grossly unfair in their pricing, even if the pricing of that insurance is completely legitimate given the expected losses that they would face. They don't want to have a situation where someone calls up Radio New Zealand and says, my insurance premiums have gone up by 500%. And in fact, that happened after the Edgecombe event when their stop bank failed. A person who lived there called up Radio New Zealand and said, my insurance premiums had gone up to $5,000 a year. He said, I'm a pensioner. I can't afford $100 a week on insurance. And so insurers don't want to be in a situation where people are told the price of their insurance and people find it so excessive it feels unfair. So what we have seen is that insurers will start to withdraw insurance, even if there might be some people who would be willing to pay for it in the retail perspective. Again, I haven't undertaken this research, but we would expect that public insurance would be the next to withdraw because of the transparency that any public institution has. That if a public institution finds that they're having to pay very high insurance premiums on particular assets, then it's likely that that information will become public, and it again, that public scrutiny might damage the reputation of the insurer. I would expect that commercial insurance would stay in place the longest, and that is because there's these contracts between sophisticated buyers and sophisticated sellers. Most commercial entities can afford to have their own in-house insurance expertise, and so they're more able to understand the information that is provided by the insurers about how the hazards are escalating and how that expected losses needs to be reflected in much higher premiums. So that's the sequence that I would expect to see. We don't know what the levels of retreat, the thresholds in the commercial space are. I would be, open to undertaking that research, but we haven't seen those numbers yet.
The next question is from an anonymous person again. New developments in at-risk areas have been proposed in our region. What are your thoughts on the National Adaptation Plan, which is to be released next year?
So the National Adaptation Plan needs to, I think, incorporate the speed at which these hazards are impacting these key financial levers, so insurance and banking. And that is something that we will have some conversations with the central government about and provide our advice to them in terms of the National Adaptation Plan. But I think that we do need to be thinking about the mechanisms that will reduce risk in the long term, as opposed to provide a temporary level of reassurance, such as defences or even accommodation, that may be popular with those most affected, but is not in the best interests of society in the long run.
The next question is, how aware are insurers that 1 in 50 or 1 in 100, 1 in 200 inundation event flood levels include a component of sea level rise relative to that horizon and aren't equal to a 2%, 0.5% AEP inundation event with current sea levels?
That sounds like a coastal engineering question, and that might be outside my area of expertise.
Fair enough. The next one, these are big issues. What can I do as an individual right now?
I think the key thing is to be active, be involved with your local government as much as possible, to get your head around about how these changing distributions of events, how much impact that will have on everyday decisions. So I talked about that distribution shifting to the right and changing in shape. I think getting an understanding about how much those events are changing, and then linking those to how you are making decisions. One of those is on insurance, but the other one is if events become more frequent, then nuisance flooding becomes more frequent as well. And so even if your house is high, if it's difficult for your kids to get to school because the road floods out every few times a year, then there's impacts on your day-to-day decisions that you might not previously have considered. So a key thing I would say is start to get your head around how these extreme events are changing and get as involved as possible with local government.
The next question is from Ollie. How could the climate leases approach be integrated with dynamic adaptive pathway policy response?
Mm-hmm. So one of the potential areas is that it is one path along those pathways. The triggers that are applied within the adaptive pathways are likely to also be relevant for climate leases. What I would say is that New Zealand will have different approaches to the adaptive pathways than other locations will have, simply because the amount of economic might that we have sitting behind the length of coastlines and river plains that we have. So what it might mean is that we need to make decisions sooner than you might need to make them, for example, in the Netherlands, which has, as an example, 47 times the GDP per kilometre of coastline that New Zealand has. So the climate leases is something that absolutely could be integrated in and could help the evaluation of the different options to be made in the interim. Including, for example, there may be some locations where you have a stop bank in place and there's support to undertake remedial maintenance of that property, but recognition that it will need to be dismantled within a period of time because fortifying it, building it higher and wider is not supported by the funding that's available, the risk to life that could cause. And so you have a inclusion of that adaptation in the short term, but a recognition that in the long term you will need to move out of that location, which the climate lease will send a very strong future signal of.
Great. The next question is from Chris L. Does conversion to leasehold push risk onto government as the underlying owner? in effect a subsidy the same as public insurance? What is the day one cost to convert to a 100-year leasehold?
So the key thing would be around how the lease is structured. So I don't support the government becoming a landlord, because then it increases the expectations that people would say, well, you need to continue to provide me with a service during that time. So instead, I would say that while there might be compensation paid to extinguish those permanent rights, you don't then convert into a lease having a relationship with the Crown being a landlord. So you are removing the right for permanent occupation, but you're not adding in a whole bunch of additional rights of tenancy. So that is something that I would suggest. In terms of a 100-year lease, it's quite small. So it depends on the particular location and how much those hazards, how quickly those hazards are escalating, but it might be 10 or 20%. I'm less worried about the locations that have that longer time period. I'm more concerned about those locations that have maybe 10 to 70 years left. Those are the locations that I think are more likely to be candidates for the climate leases.
The next one's from Richard. He says, I think real leadership can be made by local government with infrastructure retreat, like the idea of climate lease. Would prohibiting any existing redevelopment work as well, maybe for at-risk homes?
So that's what some locations globally are doing, is they're saying you can remain in place, but you can't renovate. One of the advantages I see of climate leases is that it gives people much more flexibility about that, while still sending a really strong signal to put a economic break on significant intensification of development. So at the moment, that is something that a council can do, to say you can't renovate a location. But if there's a location that has, say, 40 years left, and you want to renovate the kitchen, but you accept that it's only got 40 years left, then that might be a sensible thing to do. A climate lease would allow you to do that. So once you have agreed to the time period on it, what you do with that structure to enjoy it during the remainder of that period is up to you. Because anyone who would buy the property would have very clear understanding of how long the property is likely to be safely inhabitable for. So that's say that 40 years. And if you happen to have renovated the kitchen during that time, then that adds value to those remaining 40 years. At the moment, though, it is a blunt tool and is to stop redevelopment is one of the few tools that councils have available to them. And I would say that potentially means that you have a situation.
We've got lots more questions coming through, so just a reminder to everyone that's listening to please vote for the ones you want asked.
The council needs to say no to everything, because if they
Next
don't,
question is,
you've
how
got
can
a
you
danger that
assess
you've got
investment and
significant new
payback
structures
periods
or massive
versus insurance
redevelopment being
period
undertaken?
if insurers don't provide the threshold when they'll stop insuring?
Because we're able to get, while they may not tell us what their level is, we're able to undertake analysis that indicates that it would be extremely difficult for them to continue to provide insurance beyond this point. So we don't know if the number is 1 in a 75-year event or 1 in a 25-year event, but we know it's not more than that. That's in terms of residential insurance. In terms of commercial insurance, that's something that's still being assessed. But what we are undertaking a different piece of research on infrastructure retreat, looking at those payback periods. And the key piece that we're looking at there is the time to failure. So looking at the payback period on a piece of infrastructure might be 50 years, and the expectation that it will provide a level of service. Say a stock bank is expected to provide a level of service of a 1% AEP. If that becomes a 5% AEP by the end of that asset life, then that should be incorporated into the due diligence that has been undertaken today. Because if you're building a new piece of infrastructure with a payback period of 50 years and a service level of 1% AEP, but you know it's going to start breaching that well before the end of the 50 years, then the 50-year payback period needs to be recalculated. And that is a piece of work that we are currently undertaking, where we are putting together an atmospheric model with a hydrological model with service levels and infrastructure.
When is a 1% AEP likely to become
financial
5%
hurdles
AEP?
to come up with a modelling chain that will tell us about how the time to failure interacts with the payback period under climate change. That's a whole different presentation. If you'd like me to talk about that, I can bring in my colleagues and we can do a different presentation on time to failure and infrastructure. So it depends on that tidal range, but in Wellington, we expect that to happen with just 10 centimetres.
And next question is from Rachel again.
So
from a local government
really
perspective,
so
if
that's
a property is subject to
definitely
insurance
within the next
retreat,
20 years.
is there a risk that lenders, e.g. LGFA, might
in
call in
places
their
like
loan?
Nelson, it might be 30 years, but it's not much longer. That's all. I mean, there's specific detail that I can pull out for specific locations, but that's a separate piece of work. There will be, if there is more confidence that there will be this liability risk. So the way that lending to infrastructure is currently primarily based on the asset itself and insurance for the asset itself. But as lawyers become more successful in taking liability claims against local governments for
the next question
the
is,
damage
to what
that occurs
extent
to
is
other
insurance
assets
retreat already
when
happening in
that
New
asset
Zealand?
fails, then yes, there is likely to be change in the cost of capital for those properties. I can't comment on any particular lender without seeing the detail, but you would expect that the cost of debt on those assets will increase and in some cases will no longer be available. So there are locations that we are confident are unlikely to currently have insurance available to them. But that is information that we are not able to require insurers to disclose.
Great point. This will be our final question for
even
today.
the regulator of the insurers don't
What
have
are
that
your thoughts
information.
on the government's infrastructure
My
fund
colleagues and
in
I
terms of their
at
long-term
the
responsibility
University
for approving
of
projects in
Wellington have
vulnerable
made a
zones?
submission to the government to say that that information should at least be provided to regulators. Even if it is not provided to researchers, that information should at least be provided to the regulators of the insurance sector. they absolutely need to be undertaking due diligence about how those investments are likely to respond to escalating hazards under climate change. That due diligence is not being undertaken with any in any meaningful way.
I think that's a great question to finish
in
on there.
part, that's because the modelling
On behalf of the
hasn't been
branch, I'd just
available
like to
yet.
say thanks very much, Belinda, for coming along and talking to us
And
today.
that's in
It's
part
been
why
very enjoyable and very informative.
Greg and I are
I'll now hand
helping
over
to
to
develop some
Nathan
of those
Edmondson
models to
to
answer those
close
questions.
the meeting.
But at a
Thank you,
minimum,
Steve. Thank you,
there
Belinda.
needs to be far more
Amazing
due
presentation
diligence
and
about how
a lot of
escalating
questions
hazards are going to change the
being asked, and
financials of those investments.
amazed you're able to keep answering all of them. Well done. A lot to take out of that, so thank you very much. One thing that stuck in my mind from what you said was around fortifications and insurance companies looking to potentially sue governments or local bodies if those fortifications potentially fail and they are in the gun for insurance payouts. So that's certainly something I had not thought about, and wow, so a lot to consider. So thank you very much, and I'm sure there's more questions that haven't been answered, so we will pass those on and hopefully have answers for everyone shortly. Thank you all for attending and staying around as long as you have. Have a good afternoon.
Hi, everybody.